Warning signs when managing your retirement funds. If anything doesn't feel right about your retirement savings approach, now is the moment to figure out where you can make adjustments. Identifying potential difficulties early on can help you ensure a comfortable retirement later on. Here are some red flags that something is wrong with your retirement plan, as well as quick adjustments to get you back on track. Disclaimer: this video only explains the warning signs when managing your retirement funds. See your financial advisor for more concrete retirement planning. What are the warning signs to look out for when managing your retirement funds? There are several red flags that signal mismanagement of funds, and for retirement, they're not difficult to see. From lack of strategy to a debt-ridden retirement, there are a couple of warning signs to look out for. Lack of strategy. If you've been irregularly saving or putting money into a 401k, it's time to sit down and figure out how much you have. While there are more and less optimum ways to approach retirement, any plan is preferable to none. Begin by discussing your alternatives with a financial counselor and your company. You may discover that you can contribute more to your 401k each year, or you may opt to put a certain part of your paycheck into an individual retirement account each month. No automation. If you look for additional money to put down at the end of the month after all your other bills have been paid, you may quickly fall short of your retirement goals. To improve this issue, make savings a monthly automatic deduction from your payroll or bank account. Develop the habit of paying yourself first by taking monies for your retirement account from your paycheck before any other costs are withdrawn. It'll be easier for you to adjust to living on the balance of what's left. Channeling all your funds into one investment. When it comes to retirement planning, diversification is essential, and your portfolio should reflect that philosophy. Because markets are volatile, it's tempting to retain the majority of your retirement savings in conservative asset classes like cash or certificates of deposit. However, these items are likely to underperform the market and fall behind the rate of inflation. Aim for a portfolio allocation that includes a mix of stocks and bonds that represent your risk tolerance. No talks of meeting from your financial advisor. While consulting with a financial advisor can prove to be helpful in retirement planning, it's also vital to check in on a regular basis to evaluate where you can improve. If you created a retirement plan but haven't examined it in a while, your retirement plan may have gotten off track without you realizing it. If you recently got married, changed careers, or relocated to a new home, you may need to revise your strategy. Failing to account for rising healthcare expenses. According to a Fidelity study, a couple retiring in 2018 will need approximately $280,000 to cover healthcare costs in retirement. With healthcare expenditures anticipated to climb in the coming years, it's critical to factor these costs into your retirement planning. To help you better prepare for retirement, a competent retirement financial planner may help you undertake a detailed study of maintenance costs, insurance rates, co-pays, deductibles, medicines, and estimate possible long-term care needs. Regular but insufficient savings. You're probably on the right track if you set aside about 5% of your annual salary for retirement. However, if you boost your savings rate, you'll enjoy a more comfortable retirement. Your savings rate has the most impact on your capacity to meet your retirement goals. You should save at least 15% of your gross family income, including any employer matching contributions. Examine your present budget and see if there are any areas where you can make changes to attain that 15% threshold. You may be able to save money on entertainment, dining out, and other expenses in order to contribute more to retirement. Saving a few percentage points more of your earnings each year could result in hundreds of thousands of dollars more when you retire. Providing financial assistance to people at your own expense. Whether it's a relocating adult kid or an aging parent, providing financial aid to family members can be costly in the long run. When you're financially dependent on others, it's quite difficult to be financially independent. While it is necessary to financially help family, it's also important to avoid snowballing your financial support at the expense of your personal long-term financial goals. You may need to minimize the amount you spend to help others in order to put those monies towards your own financial future. Debt-ridden retirement. If you have big credit card amounts, a home equity loan, or a large mortgage, it may be time to start getting rid of these sums. Many retirees bring significant debt with them into retirement. Addressing your debts now may free up funds that can be used for other living expenditures in retirement. Consider taking a practical approach to debt management, even if it involves downsizing your home or other assets in order to minimize debt levels before retirement. Here's a major risk to avoid as you approach retirement in 2022. If the stock market's volatility is causing you concern as you near retirement, it may be time to rethink your portfolio. One of the major concerns you may face as a new retiree is a prolonged market slump, just as you need to begin drawing down your funds. Because research suggests that this can affect your portfolio in the long run, it's worth going into retirement with your funds allocated in a way that mitigates that risk. The major indices have continued to zigzag their way through the retreat. With the Russia-Ukraine conflict heaping uncertainty to an already shaky market, the S&P 500 index, a broad indicator of how U.S. firms are performing, is down 8.8% year-to-date as of Monday's close on March 1st. The Dow Jones Industrial Average is down about 7% this year, while the tech-heavy NASDAQ Composite Index is down 13%. However, the math appears better in the long run. The S&P 500 has been up more than 12% in the last year. The Dow is up roughly 7.5%, and the NASDAQ is up around 1.2%. While predicting where the market will go from here is impossible, volatility is predicted to persist. The ups and downs of the stock market often matter less for long-term investors, those whose retirement is many years or decades away, because their portfolios have time to recuperate before being relied on for income flow. In retirement, things are different. This might be especially difficult for people who are just starting out in life. In essence, research has demonstrated that a sequence of returns risk can have a long-term detrimental influence on your portfolio. This risk is essentially concerned with how the order or sequence of your gains or losses over time matters when it comes to liquidating investments. If your intended retirement date is near, it's worth looking to see if your portfolio is built in such a way that this sequencing risk is addressed. In general, this implies avoiding stocks and other risky investments with any money you'll need to cover your expenses. That being said, what are the signals that you should consider postponing your retirement date? Signs that it's not financially time to retire. What it truly takes to retire is a firm handle on your budget, a thoroughly studied investment and spending plan for your life savings, your debt under control, and a plan for how you'll spend your days that you're pleased about. With that in mind, what are the warning signals that you aren't yet ready to retire? High debt levels. Large amounts of debt will severely limit your retirement savings. Reduce or eliminate credit card and car loan payments if possible. Paying off your mortgage or downsizing may also benefit you in the long run, depending on your situation. Paying off debt before retiring may require you to work longer than you'd want, but it will most likely be worth it for the peace of mind that comes with not having all those monthly bills hanging over your head. Getting rid of debt, especially your mortgage, also means avoiding interest payments, which can have a negative impact on your long-term finances. Trouble paying your current bills. It goes without saying that if you're trying to make ends meet with a paycheck from work, retiring will not make things any easier. In general, retirees may require approximately 75% of their pre-retirement income to live well in retirement. Social Security, pensions, 401ks, IRAs, and other accounts often provide this income. Will those sources provide you with enough revenue to pay your commitments while still allowing you to enjoy your free time? Transportation and dry cleaning expenditures will fall, while entertainment and travel prices may rise. Furthermore, taxes and healthcare expenses must be covered. No proper planning for future major expenses. You don't want to put off significant foreseeable bills like fixing your roof, repaving your driveway, acquiring a vacation property, or getting a new automobile until you're retired. These higher charges can quickly pile up. particularly when monies are withdrawn from taxable accounts and taxes must be paid on every dollar. Lack of monthly financial plan. When you retire, your paychecks stop coming, but your bills continue to arrive. Before you retire, you should plan your monthly financial flow. Planning your monthly cash flow entails evaluating when you will begin collecting Social Security payments and how much you'll get, as well as how much and in what sequence you will withdraw from your personal retirement accounts. If you have both a conventional and a Roth IRA, you must consider the taxes and required minimum distributions, RMDs, on traditional IRA withdrawals, as well as how this affects Roth IRA withdrawals, which are not taxed and are not subject to RMDs. Unknown Social Security benefit. While you may not count on Social Security to cover the majority of your expenses, you should not disregard it either. If you're like most individuals and haven't calculated how much your benefit will be, the Social Security Administration has a simple tool to assist you. If you haven't reached the full retirement age for Social Security, the age at which you can earn your maximum monthly Social Security benefit, you might consider delaying retirement until you do. If you begin collecting Social Security at the age of 62, your monthly payments will be 30% lower than if you wait until full retirement age. If you continue to work that 4 or 5 extra years, you'll not only receive a larger monthly payment merely for waiting, but you may also enhance your payment by including more high-earning years in your benefit computation. Of course, you'll have a few more years of wages to save for retirement. And final thoughts. If you want to retire before the age of 65 when you become eligible for Medicare, you should be aware of a 6th warning sign. You don't know where you'll receive medical insurance or how much you'll have to pay for it. If you notice one or more of these warning signs, don't worry or beat yourself up. It's never too late to begin planning. The links to prior posts mentioned above and in the list below are excellent places to begin. You'll notice significant development if you take things one step at a time over the following few weeks and months. And having stronger preparations in place will allow you to concentrate on what's truly important, enjoying your life. Thanks for watching. Click on the like button and subscribe to get more of our videos.